You can be successful in a strong financial position and still feel like you were never given the tools and the knowledge to clearly think through markets, economics, and global events. Right now, with smartphones and social media putting a constant stream of headlines in front of you, it is easy to feel overwhelmed and unsure how to separate what actually matters from what is just noise. That's exactly what Pointe Perspective is for. A steady framework that helps you think clearly, stay disciplined, and keep building your financial future. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. Today, we'll talk about how markets price risk and why incentives drive emotional reactions. And we'll close by building a financial action plan that you can execute. Now, let's talk about what you're seeing in the markets, because this is a perfect example of how a fast headline can create fast emotion. And emotion is rarely a reliable investment signal. The Greenland story is a perfect case study. President Trump has publicly said he wants to pursue acquisition through negotiation, and he has ruled out using military force. Now that matters because, as we've discussed in previous videos, markets price pathways just as much as they price outcomes. A negotiated offer is a very different scenario than a forced conflict narrative. So what could this mean for the markets? When an issue like this hits the news cycle, investors tend to filter it through a few channels. First, the strategic and defense expectations. Greenland is strategically positioned in the Arctic and has been discussed in the context of U.S. security interests in the region for decades. When investors believe security priorities are shifting, it can create a tailwind for areas tied to defense, aerospace, or related infrastructure, not because anyone is cheering for tension, but because markets are repricing expected demand and government spending. Second, the minerals and supply chain positioning. Greenland also comes up because of the mineral potential and the broader race to diversify critical mineral supply chains. That headline can lift interest in areas like mining and processing strategic materials because investors start connecting dots around long-term supply constraints and national security priorities. But this is where discipline and patience matters. Potential is not production. Development can be complex, expensive, and slow, so think years, not months. Markets may flirt with this theme, but sustained momentum typically requires real projects, real permits, and real capital. Third, the diplomatic and trade risk. The market's short-term sensitivity often comes from what this story implies about alliances, tariffs, and the broader trade posture. Tariffs are not just politics. They can feed into inflation expectations, corporate margins, and growth assumptions. And that's why markets can move quickly even when these types of trade headlines heat up. And lastly, the bond market response. This is where sophisticated investors should pay close attention because the bond market often reflects the market's clearest assessment of risk. Now, if you missed last week's discussion on the bond market, you might consider going back and watching week 3. It will help this part make sense. When geopolitical uncertainty rises, you can see a risk-off move, which is when money shifts toward government bonds or other perceived safe havens like gold. This can push yields lower. You can also see the opposite if markets begin pricing tariff pressure, inflation risk, or policy uncertainty, which can push yields higher. So the stock market reaction can look confusing on the surface because the real question sits underneath. Is this headline increasing uncertainty in a way that tightens financial conditions, or is it mostly just noise? And that brings us to the core point, and you'll hear me say this over and over. Markets don't move on fear alone. They move on expected changes in cash flows, costs, and confidence. Headlines might be the trigger, but the mechanism is expectations. What investors think might happen next. This sets up our next section perfectly because these outsized reactions are not only about market structure, they are also about human structure. Incentives shape behavior, and behavior shapes market reactions. We've spent the last few weeks talking about behavior and how people react under uncertainty, and why emotion can distort decision making. This week, I want to take that one step deeper and anchor it in something that's much more structural: supply and demand. At its core, economics studies how limited resources are allocated. And as we discussed, that limitation is what we call scarcity. And scarcity forces choices, not just for individuals, but for governments, corporations, and entire economies. When incentives change, behaviors change. And when behaviors change at scale, supply and demand shift. When supply and demand shift, prices follow. That sequence is always happening. It's a constant loop, whether we're paying attention to it or not. So first, what is supply and demand? So supply is how much of a product is available, and demand is how much consumers want it. High demand and low supply creates a shortage and pushes prices higher, and the seller is able to capitalize on the scarcity of that item. So a great example of this, Taylor Swift Eras Tour tickets. Demand was extremely high, supply was limited, and pricing reflected that. Now, when there is low demand and high supply, it creates a surplus and forces prices down to attract more buyers. We see this at the end of every season. So, for example, the best time to purchase a Christmas tree is right after Christmas, when demand is low and the prices are too. Now, let's apply this to the headlines that we're seeing. When geopolitical tensions rise, it changes incentives around production, access, and control. Governments become more focused on securing resources. Corporations rethink where and how they source materials, and countries reassess dependencies that they may have taken for granted. That process directly affects supply. At the same time, demand doesn't disappear. It can even become more urgent. Energy still needs to flow, materials still need to be mined, and food still needs to be produced. So when supply becomes constrained or uncertain and demand remains steady or increases, prices adjust. This is why conflict and geopolitical tension often show up first in commodities, energy, transportation, and manufacturing, long before people feel it in their daily lives. And that's an important distinction. Supply and demand dynamics don't mean prices move immediately or permanently. It just means that the balance of power in the system is shifting. Sometimes those shifts are temporary, and sometimes they become more structural. The job of a sophisticated investor and a thoughtful planner is not to react to every price move, but to understand why those pressures exist and whether they are likely to persist. This can also be why markets can seem counterintuitive. Rather than focusing only on today's shortages, prices reflect expectations about future availability, production, and adaptation. If markets believe supply constraints will ease, prices may stabilize even when headlines remain intense. If markets believe constraints will last, prices can move long before the impact actually feels real. Understanding supply and demand matters because it affects inflation, wages, interest rates, and ultimately, your personal purchasing power. Along with interest rates, supply and demand shifts tend to be the biggest drivers of what everyday households feel through inflation. So the economic takeaway this week is, when the world feels unstable, don't just ask what happened. Ask what is becoming more scarce and what is becoming more valuable because of it. That question keeps your thinking grounded in economics instead of emotion. Now, moving on to our strategic planning focus this week. Over the last few weeks, we've been building toward this point. First, you defined what success looks like and got very clear on your goals. Then you identified the habits that support those outcomes and evaluated the tools available to you. And this week, we're putting it all together to make it operational. Because you can be crystal clear about your goals, but unless you execute a plan, nothing actually changes. An action plan does not need to be complicated, but it does need to be specific. The framework is simple. Who will, do what, how much, and when. That same concept applies whether you're managing your household finances on your own or coordinating decisions with a spouse or an advisor. So here's what I want you to do this week. Take the goals you've already identified and translate them into 1 or 2 concrete actions that can be implemented immediately. Not someday, not when things feel better, but now. For example, if your goal is to build investable cash flow, decide how much will move automatically each pay period and set it up today. If your goal is control and awareness, decide which accounts handle spending, which are going to handle saving, and where boundaries need to exist. Then set up that structure. If new accounts are needed, stop putting it off. Just open them. Discipline comes before momentum. Action planning works best when the friction is removed. That means leaning on automation, structure, and clear rules rather than relying on your own willpower. Once a plan is in motion, adjustments are easy, but you can't refine something that doesn't exist. Next week, we're going to evaluate cash flow, but not in a traditional budgeting sense. Budgeting is dead. It is largely outdated. I'm talking about strategy. We'll look at where money is actually flowing, what it's supporting, and whether it aligns with the outcomes you say you want. Because before you stress about investment or chase performance, cash flow will always tell on you. This week is about putting the framework into action, but next week is about making sure that everything is pointed in the right direction. As we close, please keep in mind, if you're building wealth, your advantage is not reacting faster than anyone else. Your advantage is in thinking more clearly than everyone else. It's not about an opinion, it's about opportunity. This week was about understanding what markets are actually responding to and then making your plan operational so you're not negotiating with your emotions when volatility shows up. Now, if you enjoyed this conversation, please use the link to subscribe to our weekly newsletter or subscribe here to see all of our discussions. We did go over a lot today, and I hope this information offered some useful perspective. So until next week, take care.